Today's cardinal lesson is really going to address what I find the number one worry of people coming in their 60s, where they've accumulated this pot of money in their retirement account, and they've got it and they've been accumulating it forever, and now at retirement it's time to start making withdrawals. And the number one worry that people have is, I'm going to be 80, 85, 90. If I start drawing out too much, I'm going to run out of money. And then I'm going to be old and out of money. And so we use, in financial planning, we use annuities for part of the customer's money. And what I'm going to talk to you about today in the lesson is talking about income riders, the guaranteed monthly income for life. So when you purchase one of these income riders on an annuity, the insurance company will guarantee to you that when you start an income, and the example I'm giving today is on two people, but it could be on one. When you started on a couple, that as long as either one of you is alive, in this couple's example, the monthly income that you started is guaranteed by the insurance company to last as long as you live. So that's something that's unique to annuities. We use a whole wide variety of financial products to help our clients solve their retirement problems or solve their retirement income problem. And we put their money in different places. At least we propose to do that. And we're going to use an annuity or a couple of annuities in the area where we're going to use the word guarantee. And so it's the later years that we want to have no uncertainty, and we want to have that word guaranteed. So in the example that I have here, this is a real client that's just coming in, a couple, they're both age 67. They're have pretty substantial Social Security checks. They've got a pretty good savings. They've got much more money than the $300,000, or I shouldn't even say much more money, but enough more money in, it's all in a retirement account. One of the challenges they have, and a lot of people face, you might be facing this, is I've got this big pot of money, but it's $500,000, $600,000, $700,000, but I've never paid taxes on any of that money. And now when I start withdrawing it, I got to pay taxes. So that's one problem. And if you draw a whole bunch of it out at once, you're going to pay a lot of taxes. And that's where this guy is. The second problem is if you start chipping away at his larger balance and you take too much to live good while you're in your 60s and 70s, you might run out of money. And so what he charged us with the financial plan is to make sure that doesn't happen. And the financial plan is mixed in with a tax plan and mixed in with his Social Security benefits so that everybody lives happily ever after. Now I'm going to get into the example and the numbers in a second, but I want to talk about this guaranteed monthly income for life, or the income rider. So the first thing is, it uses an acronym, an abbreviation, GMWB. It's Guaranteed Minimum Withdrawal Benefit. And you'll notice the word guaranteed. So when you purchase an income rider, and you typically have to pay for these, you pay for it out of your savings account, and the insurance company is guaranteeing that once you start an income at a certain level, once you start it, and that could be on two people, a husband and wife, that income is guaranteed to last the rest of your life. It's that simple. And as I get into the example, you'll see that. So it's guaranteed minimum withdrawal benefit. Then it's these things, these income riders are best when you delay them at least 3 years, or you start the income in the 4th year, really the earliest, and they're really at their best if you start the income in about, at the 10th year. So in this example, we're putting in the $300,000, which is just part of their money, and we're not starting the income till the 4th year. And that gives the annuity a time to grow, and it has a guaranteed growth rate. That's the only way they can come up with a guaranteed number. It's all built into the thing. And if you have a little bit of time, and that we create the time. So this guy wants to start his income. He'd really like to start it now, but I was just showing the dynamics of this. What they're going to live off of till this 4th year is their other money, which I haven't defined for this example because I'm not teaching you about the whole financial plan, just part of it. Now, if you or your spouse, or in this guy's example, the husband or the wife, live longer than the account value. So in this example, the account value grows and then it starts to go down in their 80s and it runs out of money at 92. So if these people live past 92, they're going to be getting a check from the insurance company for $2,000 a month or $24,000 a year, 93, 94, 95, just as long as they're alive. And that's coming out of an account balance where the account balance is zero. Okay. Now, it's providing a guarantee that we have no other financial product with the other financial investments that we put into financial plans. There's uncertainty. And one of those things is we just project how long people are going to live, and then we project how much money they're going to make on their money and how much they can take out. And there's a lot of uncertainty there, and they could run out of money. With the annuity and with an income rider, we're able to guarantee a specific number. And that number is going to come to them as long as either one of them's alive. And if you or your spouse pass before the cash value is zero, okay, because if you live long enough, you will spend or you'll pull out as income at least as much as is in the annuity. And what happens, though, if you don't live long enough? So in this example, when the second one dies, okay, and then let's take as an example, let's say the second one died at 78. So they didn't live very long after they started their money. Well, this column here is a reasonable projection crediting. It's just taking the prior 10 years from now and projecting them forward. The performance of the annuity at 78, and they died, the income obviously stops, the second person died, and $282,000 would be paid to their beneficiaries, which presumably would be their children or the church or whoever they've named as their beneficiaries. Now, that's with reasonable performance. If this over here is what the insurance company is guaranteeing, they're guaranteeing essentially 0% interest every single year right from the beginning. So the insurance company, that doesn't sound like a very good proposition, but when they put up there, they're saying that if you got no credited interest, if the stock market performance was zero or backwards every single year, this is the chart you would be on, and that's virtually impossible. But nonetheless, if it happened, then the second person dies at 78, there would be a refund to their beneficiaries of just $86,000. And you can add up all of those numbers, and they're basically getting their own money back, either to them in income or to their children. And the answer of what it's really going to do, it may do better, it may do a little worse, but it isn't going to do this. But I've listed this here to just show you. On this example, it ran out and became zero, the cash value of the worst case scenario at 81. And it really doesn't matter to the people collecting the $24,000 check, because what they bought this thing for in the first place is just knowing that that's guaranteed for the rest of their life. Now, the principal is guaranteed, including the annual credited interest. So when you're going down and just looking at this example of the growth of the cash value, is once they credit you the interest, then that's yours, and that's guaranteed too. So if you had a year like after this year where you made zero interest because the market index was backwards or just flat, you're guaranteed that you're not going to lose anything that's credited to the account. So on the example, what we've done for this guy is, and his wife, is we've just assured them that they got their Social Security checks, they know that, and there's two of them, and they got about $5,000 a month that they're going to be drawing for the rest of their lives. Now, in addition to that, there's a $2,000 a month income that they've set up that will also come in for the rest of their lives. Now, there is one problem with it. When the first one of them dies, the smaller Social Security check's going to go away. So there's only going to be one Social Security check that'll live on with that surviving spouse. But the $2,000 a month will be unchanged. So there'll need to be some adjustments for that. So this is just part of a financial plan. And I really would like you to understand guaranteed minimum withdrawal benefit. And if you call us up or you're wanting us to do a financial plan, we probably are going to recommend something different. We have about 50 companies to choose from that offer these income riders. And so very little likelihood that you're going to get this example because it's different for everybody. We run all the numbers on it. I'm Hans Scheil, and I thank you for listening.